Started. We're going
As
to
soon
start.
as people are,
Okay, Jeff?
here we go.
They're all here. Go ahead.
Okay, we're going to.
Here.
Ms. Cavanis? Here. Mr. Haschak?
Here.
Mr. Shoemaker?
Here.
Ms. Harris?
Here.
Mr. Swope?
Here.
Ms. Cubison?
Here.
Pledge of Allegiance. Trustee Shoemaker, please lead us in the Pledge of Allegiance.
Ready? Begin.
Pledge allegiance to the flag of the United States of America. One nation under God, indivisible, with liberty and justice for all.
Okay, the Mendocino County Board of Retirement meeting for January 1st, 2026 is called to order at 8:40. And the first item up is the proclamation honoring Richard Shoemaker for his service to the Mendocino County Employees Retirement Association Board of Retirement. And we have a proclamation here, and I'm going to read it. Whereas Richard Shoemaker has been a dedicated and well-respected Board of Retirement trustee, serving as the alternate retired member for 3 years and as the retired member for nearly 2 terms since being elected by his fellow retirees in 2011. Richard served previously as the Board of Supervisors appointed representative from 1997 through 2005, his tenure vastly outlasting most trustees historically. Whereas Richard has been truly committed to his duties as trustee, often traveling from the coast to attend meetings, volunteering his time and expertise to consult with staff regarding Kings Court Improvement Project, and asserting his leadership at times of debate over investments and asset allocation. His experience in contracting and project management, serving on multiple boards, and operating a local business for over 27 years made him an asset to the board. Whereas Richard always put his fiduciary duties and responsibilities first and strived to protect plan assets of the Mendocino County Employee Retirement Association and preserve retirement benefits for his members and their beneficiaries. He actively participated in the retirement board's decisions, often expressing his opinion and encouraging meaningful discussions among fellow trustees regarding operational, financial, and investment issues facing Mixera. Whereas Richard's down-to-earth personality, collegiality, and willingness to speak his mind have always been appreciated by fellow trustees and Mixera staff. His interest in affordable housing, real estate, and investing introduced valuable board educational opportunities. And whereas Richard's many contributions to Mixera include selection of core and core plus real estate investment managers, participation in the request for proposal for Kings Court, Americans with Disability Act upgrades and project completion, Article 8.4 adoption and separate account divisions of community property interest, historical benefit correction project completion, and receipt of an agreeable IRS compliance statement, addition of infrastructure to Mixera's investments, reduction in amortization of the unfunded actuarial accrued liability, adoption of a strategic plan, work board plan, strategic plan calendar, among others. Now, therefore, be it resolved that the Mendocino County Board of Retirement recognizes and honors Richard Shoemaker for his years of service and expresses sincere gratitude for his dedication to Mixera. Its board full of life and love, family and missed.
You're here.
Is there any board discussion on this proclamation?
Any objections?
Yeah, you can't do this.
I just would comment that, from 1997, that is almost 30 years, if my math is right, it's getting harder and harder, of, involvement, and that's a long time. That's much longer than I'm going to be involved.
No.
And so that's very, very admirable. And thank you very much for the participation and being, on the board that long in
You-
various capacities.
Yeah.
You will be
There was a
missed.
break in the middle somewhere. Yeah, they're almost 30 years. Well, it's been super interesting. Hell to pay as well. Health insurance for life issue.
Oh, yeah.
Doing that was one of the ones I worked on with Patty Campbell, Knudsen, Anderson, and Dennis Huey, and we made this kind of interest, or had to pay this interest, and we made this kind of return. What would it do to us? And in the end, it worked out. The health insurance stuff, away from this board, I kind of led the battle to keep it for employees, being one of the 60 people in the end who were hanging out that couldn't get insurance elsewhere because of medical conditions they had. We battled to the point of the county kept us on until ACA came along, and then they released us there.
Yeah.
And that was a big deal. That was really important to a lot of people. I really appreciate and kind of every receptions with shrimp as big as your fist and all, but we're all more down to earth these days with that. I did not think about anything I'd say. I'm just kind of rambling right now, but being on this board helped me in my life a great deal, actually, and it made me more aware of the need for good retirement planning, because there was a point I had no retirement other than 8 years worth for the county and a few years for Cal PERS. And, I've learned accurate accounting is one of the most important things in the world. And following policies and understanding the rules of what you are doing, because this organization has struggled with that a few times. Also getting good employees and good consultants. I will never forget our first, or the one I came on as the first investment advisor. He was a guy that we could barely understand. He seemed to shoot from the hip, and I just thought, this is kind of crazy. While I was out, they changed over, we changed over, and that was the same thing with our actuaries. I try to live by the adage there's a difference between adventure and adversity, and it's called attitude. And I've tried to apply a good attitude to all the adversity we've had here. My other big philosophy here is we're all in this together. And representing the retirees, it led me to understand that each individual in this organization, each member needs to be supported by everybody. And if we all take a little hit in that, that's okay, because some decisions could devastate a few individuals, where a different decision, nobody in the organization, at home or at work, would really notice. So I just hope as you guys continue on that the protection of the individual is as important as the protection of the system, I think, in my mind. Hopefully the last comments, been through a lot of administrators here too, and I was trying to think through them. With Tim Knutson as the first one, in a closet office, he was half-time, and Sue Thornhill had a little closet, and she was the only full-time employee. Then we had, most recently, before Doris, was James. We had Jim Anderson. We had Rich White, who was not even really trained. He was just an important person in the Sackers. And trying to think if there was any...
Tom Watson?
Tom Watts, yeah. So anyway, it's been a very long road and mostly enjoyable, a lot of work. And thank you very much for the lovely commendation. And good luck to you all. And I may drop in by Zoom.
Good. Keep us honest.
Jerry asked me, did you travel every day? And I said, no, I've used, the last 8 years I've been here overnight because of my age of my folks and what they needed. But I'd like to apply in retroactive for my travel pay because I've never taken it in 30 years.
Oh, boy, that would be a trip.
Just kidding. Thank you. Thank you very much.
Thank you, Richard.
Thank you, Richard.
Yeah.
We'll miss you.
Yeah.
Oh, no.
Okay,
they
we
get
will
the
take
camera
a
up?
technical break here, I suppose.
And I won't repeat all that when it's on.
Yeah, maybe take a short break,
Okay.
possibly.
That was beautiful.
It really was.
You can hear me now?
Oh, good.
Okay. Oh, are we done
I
then?
think we're okay then.
That was a very, very short
Sorry.
technical break. We're not going to take a technical break. Is there any further discussion on item 1, proclamation honoring Richard Shoemaker?
Well, I'll just say that I think Richard always advocates for the public servants that we represent. And that's what I've seen this year, and I really appreciate that.
Thank you. I did leave something out. I think Doris has been the best administrator we've had.
Yep.
I paid him to say that.
Yeah.
Well, I think you were on the board through both VCP correction projects, so you've seen the worst of it, I think.
Yeah. Oh, and I got corrected.
Yes. you
That was
did.
before we were being nice to the individual.
Okay. We'll move on to item 2, number 2. Approval of cost of living adjustment, COLA, as of April 1st, 2026. Doris Rentschler, Executive Director.
Thank you, Chair Land. We received the annual COLA increase letter from our actuary, and the increase effective April 1st, payable on the April benefit check at the end of that month, is 3%. Inflation was 2.9. It's rounded up to the closest 0.5%, so the increase will be 3% effective with April 1st. And I believe this might be a motion item, is that correct?
This is. Is there any discussion on item 2?
Well, it certainly looks like it's been consistent over the years. So I would move approval of the CPI.
Okay, we're going to go to public comment at this point.
Second.
Okay.
Hi, my name
And I
is
don't
John
have-
Almeida, and I'm a retiree for the county of Mendocino. I'm making my yearly trip down here. Some of you know me, some of you don't. But I want to show my appreciation and also to Richard Shoemaker for all the years that he has represented us as employees that retire. And actually, we live on what we get, and we appreciate that. Me more than a lot, because I watched my father work, as I said before, until he died because he couldn't afford to live on Social Security. So I want to thank each and every one of you for all the work. When you don't see us around, believe me, we're here and we watch on the video and we keep up with what's going on with the newsletter. And believe me, when I need some help, I'll call Judy and let her know that, hey, I don't quite understand this, and let me know, and she lets me know what's happening. And very appreciative of all the work that you do. I appreciate the cost of living raises, of course, especially with several $100 raises. It seems like every year on my house insurance. But I appreciate what you do, and thank you so much, each and every one of you, for the work that you put in. It doesn't go without appreciation. You might not see it, but we appreciate it. Thank you very much.
Thank you for coming and doing this every time.
Once
you
again,
have.
thank you.
Yeah.
Okay, I believe we had a motion and a second.
Who was the
Let's,
second?
Me,
Oh, thank you.
you forgot me already.
and so let's proceed with a roll call vote, please, or a vote.
Mr. Kelly?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Mr. Swope? Ms. Cubison?
Aye.
And Chair Land.
Aye. Okay, motion approved. That will move us to item number 3, the consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Is there anybody requesting action on a specific item? I don't see any requests. So the consent agenda is approved. And that brings us to item number 4, investment matters. And I guess our first item up here is capital markets assumption from Callan, Greg DeForest, Claire Tellini. And there she is, and Gary Chang. We'll add him to my
I'm
list.
kind of spread into your spaces.
Oh, it's all good.
Here we
It's all
go.
good. I don't need much room.
You might need to pull that microphone so it points towards you.
Should I move this one?
Great, thank you.
There you go. That's yours anyway.
Thank you. Well, it's great to see you all. And first, Richard, it's been a pleasure working with you for so many years. You've done a wonderful job, always a steady hand. Appreciate the partnership and wish you the best of luck in your retirement.
Thank you.
Yeah. So, we're here today to talk about capital market expectations. And we go through and take a look at what we expect your portfolio to earn, capital markets to produce and return-wise every year. We go through this process every year. And importantly, we don't think we can time the market, right? Those who try to time the market are often proved to be wrong. So we don't try to time the market, and instead our capital market expectations are really 10-year projections. And this is appropriate for you because that's your investing time horizon, at least, right? Richard's been working here 30 years,
Don't
right?
rub it.
So you've got 3 of these 10-year projections under your belt. And that's the appropriate time horizon for you to invest. Not to predict, hey, what's going to happen next year based on some tweet, but really as an investor over the long run, how do we manage this portfolio for any rough seas that could be ahead of us, but also to take advantage of opportunities that are out there. So I'll walk through this presentation with you, and there are no action items at the end. So this is just a FYI. This is just an informational for you. Okay, so I'm going to flip ahead to what, back a couple slides.
Page 5?
So I call it page 4, back one. Yep, perfect, thank you. So when Callan goes through and makes our capital market expectations, there are a few things that we anchor on. The first is there's a bit of a bias towards capital markets reverting to their mean, coming close to what the long-term average is and has been for those asset classes, or the relationship between those asset classes. We try to be conservative with our expectations. We know you as an investor, if we tell you that you can make an unpredictably high return and you don't, it puts you and your beneficiaries in a bad position. So we have a conservative bias. We have a belief in risk premiums. So that's the belief that over the long run, stocks are going to do better than bonds. Small cap's going to do better than large cap. EM is going to do better than international. Credit is going to do better than treasuries. You're going to be paid for taking on these risk premiums. We believe that will occur over the long run, and that the markets eventually will be rational and clear. Now, from any one individual time period, the market may not be super rational, but over the long run, it has to clear. Otherwise, people won't be investors, right? So these are some of the biases we have when we make our capital market expectation. Other things that we do is we take a look at the economy and what's going on in the economy, current valuations. Do we have to tweak anything just a little bit here or there because of what we're seeing in the market? So right now, actually, with our U.S. equity expectation, we're giving a little haircut to it because of valuations right now. 25 basis points per annum for 10 years, right? Doesn't sound like a lot, but that actually adds up a lot over a 10-year time period. And so there's a little bit of a valuation haircut we're giving to the U.S. equity market, large cap equity market in particular right now, because of valuations. And I'll show you some slides on that when we get to it. On the next slide, so here are the asset classes you invest in and our expectations. So the 2026 expectations, the third column over. So we think for U.S. stocks, about a 7.33% return. International stocks, a little bit more. And so we think there is a risk premium in particular for emerging market equities, which represent about a quarter of that asset class. Bonds are sticking at a little under 5%, pretty close to the current yield for that index right now. Real estate, we think there's a little premium over bonds for real estate, about 6%. And infrastructure, a little bit more than real estate, about 6 1/3. Over the next 10 years, we expect cash, T-bills, to return about 3%. That's a little lower than the Fed funds rate right now, right? So it means that we expect over the long run the Fed funds rate to come back down to average around 3%. And then inflation to sit at about 2.5%. So inflation right now is a little closer to 3. So we think it'll moderate down, but not quite average that 2% target that the Fed is looking for right now. So these are our expectations for the next 10 years, next planning cycle. So that's a bit of the punchline. And we'll flip ahead to slide 7. And well, what's the market look like right now? And should that affect the way that we expect returns to occur over the long run? And, oh, by the way, over the last 25 years, have these asset classes actually produced returns similar to what I just said they might do in the future, right? So here on this chart, this is a chart that we often look at in our quarterly reporting. You'll see U.S. stocks, international stocks, bonds, real estate, and then a whole slew of alternative investments. For the year, and we'll spend more time talking about this when we do our quarterly update, that 1-year column, it was another great year to be a U.S. equity investor. U.S. stocks up 17%. And notably, they outperformed small cap stocks again, which has been disappointing, because we do believe in that risk premium should exist over the long run. Small caps should produce a better return for you than large caps. They're higher risk. But they haven't done that for quite some time. Look at international stocks. It was one of the best years for international stocks in a long time, up 30%. Look at emerging markets, up 33%. So really strong returns. About 10% of those returns is the U.S. dollar depreciating. Right? The U.S. dollar getting weaker propelled those returns for international stocks by about 10% last year. Bonds had a really strong year, up about 7%, higher than our long-term expected return. Interest rates came down just a little bit. And then real estate up about 5% for the year. And that's a little bit of, whew, we got through it, right? Because we had such a hard time with retail and office for quite a while in private real estate. Two areas that are really heavily impacted by things like COVID and then the economy changing, people being able to shop online and work remotely. So we've gotten through a bit of that pain and the interest rate backing up in 2022, and we finally saw a positive return again for real estate over the last year. It was a really good year to be an investor last year. Let's look at the 25-year column. And you'll see for 25 years averaged, U.S. stocks over 8%, international stocks 5 to 8%, bonds about 4-ish. So you'll see our long-term expectations do look a little bit different from what we've experienced over the last 25 years, but they're all more on the margin than extreme. Our U.S. equity returns are a little lower. International returns, depending on which market you're looking at, a little higher. And then the bonds a little higher. Recall we had about a decade of zero interest rates that kept that fixed income return low over the last 25 years. And then real estate a little lower than what we've actually experienced, 7% compounded return for 25 years. So the next slide. Pictures say more than words, right? Pictures are worth 1,000 words. Is that the expression? This is an interesting chart, and it kind of shares with you why you don't want to be a tactical asset allocator, right? And all of these charts, what it is individual calendar years, and then you rank the asset class that did the best or the worst, top to bottom. And if you kind of step back, and it's kind of, you don't see the same colors in the same place all the time. That's one of the big takeaways there. They bounce around.
Yep.
So you can't time this. You don't know who. If I came in here 12 months ago and said emerging market equities is the place to be for the next 12 months, you'd be like, yeah, but what about Trump? What about tariffs? What about China? What about India? What about currency? You say, no way, right? But lo and behold, it's up 35%, right? Another thing to look at is look at 3 of the last 5 years. Large cap equity was the top performer. Mm-hmm. That's really the FANG phenomena, U.S. large cap growth, the economy being driven by a handful of companies, AI investment, technology, right? That's really what was driven the market in certain of those time periods. And also don't forget 2022. So we all remember what happened in 2022. Interest rates went up a lot, had to fight inflation, right? And the highest performing asset class was cash. How about that for a year? 1 year return, what was it? 1.5%. That's brutal. And then the worst return was real estate, down 25%, small cap down 20%, EM down 20%. So keep in mind 2022, this is what capital market volatility is. It's not good every year. So we got to be able to weather these downturns when we see a negative 20% post on an asset class. Or we go back and look at 2008.
Oh, I lived that one.
That was a tough year.
Kelsters.
Best returning asset class, bonds, up 4%. Worst performing asset class, can anyone read that number? EM equity, down.
Negative 53.33.
Yep.
Yikes.
Yeah.
Right? That's painful. Yeah. Yeah, so that's 2008. So we need to be able to build a portfolio that withstands these individual calendar years that can be really painful. but at the same time, don't live like a pessimist. Don't assume we're going to have failure. There's a saying that I've been thinking about, pessimists sound smart, optimists make money, right? A lot of times people can come in and say, oh, the world is ending and this is the worst thing ever. And you vote or you invest based on that pessimism. But over the long run, you make money by investing, even if you have a problem for 1 year or not. So pessimists sound smart, optimists make money. Okay, let's flip ahead. So we've got the economy. Kind of the big picture is the economy's doing okay from a growth perspective right now. Inflation is remaining a little bit stubbornly high. And yields have been pretty range-bound for the past few years. That's a big backdrop to what we are experiencing right now. Now, within the economy, there are a lot of people talking about the K-shaped economy. So in aggregate, the economy is doing well, but it doesn't mean everyone is in the economy. And we could see some policies that try to affect that coming out. But in aggregate, the economy is growing. Inflation is a little bit stubbornly high right now. And the next slide here, we don't look at these charts with you on a quarterly basis, but if this is for the last 4 or 5 years of a few key statistics here, the size of the labor force, we'll see here that foreign-born labor force is actually decreasing, a couple million down. And at the same time, the U.S. Native-born labor force is up just a little bit, probably with the growth of the population. But the one thing about this is slightly inflationary, right? If you have fewer people working, if there's a lower supply of people you can employ, that means the price of employing people goes up, right? It's inflationary, having fewer workers. So that's one thing that we're counterbalancing here a little bit. The unemployment rate is staying relatively low, but ticking up a little bit. 4.7% was the last read I saw. Now, back in the day, when you were in college, Richard, they may have told you that this is full employment, right? That there's just always some people who are transitioning between jobs. And they thought, it's about 5% of the population is always transitioning between jobs. That's what the academics used to say. But we're now operating like, no, 4.7% is bad. We need it lower. We need it lower, right? Frictional unemployment, I think they call it. And so there's a demand to push that down. Now, notably, what will be really interesting for us as a society to evaluate over the next few years is, what does AI do with this? Is it easy to replace people with technology? How about people who drive trucks, right? You go around San Francisco, and I commute in, Waymo's all over the place. All over the place, right? And that is just step one. It's just step one here. So you got to keep an eye on that for the unemployment rate. Wage growth has been reasonable, but down from the post-pandemic spike. And initial claims and continuing claims remain pretty stable right now. Okay. So let's flip ahead 2 slides. So we mentioned that the Fed funds rate, or rather our T-bill expectation return is about 3%. Well, what do you make in T-bills now? Well, the Fed funds rate is 3.5 to 3.75. So we expect Fed funds rate to come down over time. But what do the people who run the Fed think? right? There are a bunch of people who actually vote on this. One misconception is that the chair of the Federal Reserve sets the policy. They're one person, they set the tone, they communicate, but people vote. Change one person, you may not have a different outcome on what the Fed funds rate is. That's why there's an attempt to change more than one person at a time, right?
Yeah, heard it on the news this morning.
Well, the hearing at the Supreme Court this
Yeah.
morning, right? So right now we're sitting at 3.5 to 3.75%. And what this shows is the people who vote and then a few others over any future calendar year, where do they expect the Fed funds rate to be? And you'll see for 26, 27, 28, there's a huge dispersion. There's a huge disagreement about what people think the Fed's funds rate will be or should be. That's kind of the one vague thing about this chart. Is this them saying what I think it should be or what it will be, right? Those could be two different things. But the dispersion is huge. So the people with the most information in the United States about what's going on in the economy, with theory about what economic policy should be, they don't agree. 2.5 to 4. It's a pretty big difference. And for finance nerds, that 1.5% gap that's meaningful, right? That's really meaningful. And look at the long run number, somewhere between 2.5 to 4. That means there's no agreement right now about what the standard cruising speed is for the U.S. economy. Are we looking at a cruising speed where we need, that there's really high growth, so you're going to have higher Fed funds rate? Or are we secularly entering into a time period where you need to stimulate the economy over and over and over again? Right? So pretty big disagreement. Now, with that, there seems to be some central tendency around 3.5%. Right? That's where we're headed. To me, part of the story is also uncertainty around what that is. Okay. Next slide here.
Interesting.
So, anyone take statistics? Anyone teach statistics?
PA for University of Minnesota.
What does this look like?
We noticed the pens in his pocket.
It's a tell.
Bell.
Yeah, it looks like a bell curve, right? So, in statistics, it says random things are normally distributed, right? You have an average, and then there's some relationship around that average. And you describe the width of the relationship in something called standard deviation, right? So what we're looking at here are the calendar year returns for the U.S. stock market going back 235 years. Richard was on the committee the whole time.
Yeah.
And what's amazing is that with empirical data, looking at this, it is actually pretty normally distributed, right? You could say there's a little skew here or there, but it is pretty normally distributed. Average return, somewhere around 10, and plus or minus 20, right? That's kind of what it's saying. If you look at, okay, was last year a great year? Was it abnormal? Last year was actually in the highest, most popular column, right? And we've had a number of years in those most popular columns of late. 2022, a couple rows over to the left, and 2018, a couple rows over to the left. Interesting data. What it says over the long run, if you're an investor, stay in the stock market, but you have to be able to absorb the years on the left hand of this distribution, right? The left tail risk. You got to keep an eye on it to be able to weather that storm to take advantage of the compounding returns you get on the right side of the distribution. Okay. So let's flip ahead to slide 16. So capital market expectations, cash around 3, fixed income a little less than 5, equities 7.5-ish, inflation 2.5, and private markets, we're keeping it year over year. So getting a little bit more into the weeds about how we come up with these numbers, on 17 here, we have something called the equity risk premium. So I told you we believe in risk premium when we build these expectations, right? And when we build your portfolio has a belief in risk premiums embedded within it. So what is a risk premium? It's the return you expect to earn in stocks over bonds, right? That's the risk premium. You're earning this extra premium for taking on equity risk, to be an owner as opposed to a lender. And here you see we had a higher risk premium for a long time. And now our risk premium has actually come down quite a bit. We're sitting at about 2.5% over fixed income. And there are a couple reasons that is. Well, risk premium, think about it, expected return for stocks versus bonds. There are two things in there. Your expected return for stocks and your expected return for bonds. The first thing that made our equity risk premium come down is our expectation for bond returns went up a lot. That happened a couple years ago when we exited the zero interest rate policy. When at one point the bond market was yielding 2, now it's yielding closer to 5. Yeah, our expected returns for bonds went up a few percentage points after 2022. Right, so that part went up, and the equities kind of stayed kind of similar. So that crushed the equity risk premium. That's why a lot of investors at that time said, risk reward trade-off, maybe I don't need to shun fixed income as much as I did for the previous 10 years. So our equity risk premium remains historically low, but it still exists. Now, we also build equity expected returns from the bottom up, right? In the next slide. There are a few ways you could do this, but one kind of simple way that we choose is to look at what we expect the growth rate to be for stocks, and stocks should follow the growth rate of the U.S. economy. What inflation should be, because when you sell a good 3 years from now, you're selling it in the price for 3 years from now. That inflation flows through stocks. And then you add on how much income is earned and any sort of share buyback premium. There's been this share buyback premium. Instead of paying you a dividend, they go out and they buy their stock back, right? And then adjust inflation here or there. So we get to 7.5 pretty easily looking at these numbers. Earnings growth, U.S. growth rate, 2.5%. Inflation, 2.5%. Dividends, about 2.5%. That gets you to 7.5 pretty quick. And then we have our valuation adjustment right now, where we're taking a little bit of haircut because we think PEs are pretty high, especially for U.S. large cap right now. So why do I think valuations are high? On the next slide, here we look at forward PEs. So this is the price of a stock for next year's earnings, right? And if it's 22, it means that if I'm going to earn $1, I should pay $22 for that dollar today. Right, that's what the forward PE essentially says. So right now, for every earning in the United States, we're paying about 22.8 times that earnings to buy a stock right now. Right? So is that high or low? Well, let's look at this history over the last 30 some years and look at the average. So the average is 17. The average over this time period is 17, where you pay 17 times earnings, and we're currently at 22.8. So it's running a little high. And the bands that we have on here is that Bell, we're going back to the statistics here, it's 1 standard deviation high and low from that. And now we're over 1 standard deviation high in PE multiple within the United States. So it makes the stock market look a little expensive based on this historic measure. Now, this doesn't mean we're predicting a collapse or anything like that. But you should be mindful that this thing is priced pretty fully right now based on the next 1 year. How does this change over time? Well, there are 2 pieces of the PE, right? The first is the price you pay, and the second is the earnings. So what if we start earning more and more and more and more? It justifies the higher PE, right? If your earnings growth is higher than it's been historically, it justifies the PE. But if you don't live up to what the market expects in the earnings and earnings growth, if NVIDIA doesn't grow to the sky, then it could be an opportunity for the market to pull back. I'm going to get these numbers wrong. So let's just kind of use round numbers here. Right now, 10 companies represent about 40% of the U.S. stock market. They represent 30% of the earnings, right? So both are huge numbers. We got 10 companies, 40% of the market cap, 30% of the earnings. Huge numbers. How do you justify paying the price being 40% when the earnings is only 30%, though? You think that 30% earnings has to grow faster than the rest of the market. If it doesn't, then those 2 things should fall more in line with each other. Okay, so that's valuation in the U.S. Let's look at valuation. And there are many ways you can look at valuation. This is kind of a very intuitive way, price-earnings ratio. How about international? That's the top of the chart here. We're running at about 18 times earnings. Average is 17, so pretty close to average. And then in emerging markets, we're running at 18 and the average is 15 right now. So the run-up in price for EM is certainly showing in the PE ratio right now. Okay. Okay, so that's how you build up and look at returns for stocks. Okay, what about fixed income? So with a bond portfolio, your expected return, starting point, okay, what's the yield, right? How much am I getting paid to give you money today, assuming I get that money back in the future, right? So current yield on the Barclays, the Bloomberg aggregate is about 4.5, 4 3/4. It changes by the day. And so that's our starting point for return expectation. So here you'll see that we've been kind of in a very much a range-bound area for the past 3 years. We've been hovering around this 4.5 to 5% ag yield for quite a while. We don't expect this to change dramatically. The short end of the curve might come down a little bit, but we expect to kind of be in that similar range-bound area for a while. That's our baseline expectation. Anyone see the stock market yesterday?
Oh, it dumped.
It dumped. Wow. Why?
It's gonna dump more today.
It's up right now.
Is it really?
Yeah.
It's almost recovered. When I
Yeah.
left, it almost recovered everything it had lost yesterday.
Oh, my heavens.
Yeah.
To be fair, it was only down, 2.5%. I'm not sure I'd consider that a dump,
Yeah.
but, I think we're also a little spoiled.
Yeah.
Oh, yes.
Agreed.
Yeah. Yeah,
Just the
and it
market.
kind of erased the year's gains too, right? Year-to-date gains, but
Been going on for a
down
year.
2% in one day that's a good move. Right? That's a pretty good move. Yeah, I mean that's painful. Why?
Greenland.
Yeah.
Part of it.
Denmark.
Part of it. So geopolitical risk. Japan.
Ah, interesting.
Really?
Part of it was Japan too. So, in the Japanese bond market, there was the idea that Japan can't sustain its fiscal house with the new stimulus program. Japanese bond yields went up a lot. Okay? And do you remember what happened in Europe or the UK a couple of years ago? Same thing happened where they came out with a super stimulative policy and the bond market said, nope, we don't want that. Yields go up. What happened when Liberation Day first went? Yields in the US went up. And higher yields there can be scenarios where fiscal uncertainty, inflation expectations going up, drives up yields a lot, right? So that's the risk to the bond market here. And the risk for us as managing portfolios is, well, what happens when the stock and the bond market becomes correlated, right? Yields go up a lot, means the price of your bond goes down. And that's harmful to the U.S. equity market too, and all equity markets out there. So that's the one risk thing out there. It's something for us to kind of keep an eye on. So in Japan, there's a lot of money invested by Japanese investors outside of Japan. Why do they do that? Because their yields are so low, and you can make 4.5% in the United States. What happens when their yields start going up? Their yields are higher. Their local investors say, oh, I'll just invest in Japan. I'll just put my money in the Japanese bond market. And then that means you sell treasuries. And treasury yields go up. Right? So we're kind of going backwards in trade policy and all of that. But the global financial markets are interlinked with each other. We can't ignore that. There's $10 trillion of European assets invested in U.S. assets. What happens if they don't want to invest in the U.S. anymore? Right?
Did you hear them this morning? What our president said to the Europeans?
Did you listen?
Oh, I got it, yes.
Okay.
You're all going to enjoy hearing this one.
I haven't heard all of it yet, but
It was brutal.
yeah. I heard Trump may have rolled it back a little bit, but this is all like different measures of, measured on different scales, right?
Well, we won World War II, among other things.
Yeah.
It was not pretty.
Yeah. And then final, we have our real estate expectations here. I kind of alluded to already that office and retail, they have higher cap rates now. We've kind of survived a little bit of that. Expected returns closer to the 6% range. Okay, so on slide 24, what's this mean for your portfolio? So all in, we expect a reasonable return expectation before alpha for anything else of a little over 7%, 7.1%. Not dramatically different from previous year. and this volatility, the standard deviation of 12. Right? So I'm coming to tell you, hey, you're going to return 7% plus or minus 12. You're like, Greg, what kind of forecaster are you, right? But to us, that volatility number is an important thing to try to get right as well, right? 7 plus or minus 12 in any one given year. Well, we think you'll average 7 over the long run. Any one given year, plus or minus 12 in a one standard deviation event. So that volatility is expressed on the next slide, on 25. So over 1, 3, 5, and 10-year time periods here, you see the middle of those bars is the expected return for any one time period. And you'll see the expected return goes down over compounding. That's something called volatility drag. When you invest in something that's volatile, your average return, compounded return, actually goes down over time. So in any one year here, we think you could be up 27 or down 11. It's a very reasonable. That's very normal. That's very normal. This is what capital market volatility is. This is what the volatility you get for being an investor. And over the long run, I think you're averaging about 7, and then plus or minus 5 or 6 for any 10-year time period. And you might ask, well, Greg, what have we earned over 10-year time periods? It's on the next slide. So this chart is rolling 10-year returns. So every bar we're looking at is a 10-year return, looking backward, experience return for your plan. And every bar is the subsequent quarter, right? So and then the green line here is 6.5%.
Yeah. It looks pretty good.
Yeah, so ever since 2018 forward, you've been averaging above that 6.5%. So that's the benefit of being a long-term investor, investing in risk premium over the long run, not trying to time the market, being prudent, disciplined investor, right? And taking what the market gives you, right? So that's what you've experienced for the last decade here. Now, notably, it's not always north of 6.5%. So if you look back in the 2026 time period, that captures 2008, right? We were talking about 2008 earlier, right? So if you started investing around that time period, that 2006, that's 2016 is 2006 to 2016, right? That captures it. Expected return was 5.5%, or your experience return was 5.5% for that decade. And those are tough. Those are tough time periods. But last little bit has been quite strong for us. And talking about compounding, that's on the next slide.
I have a question.
Yeah.
So in 2022, when the S&P went down 18%, our 10-year project was still...
Our 10-year rearward-looking return.
Yeah, was
Yep.
still above 6.5.
Yes. That's correct. Okay, and then finally, here are the cumulative returns for the plan over time. So if you started in 2011 and kept on growing, this has been the growth rate on compounded returns. So it's not always up, but it's been a climb up the mountain. This is hiking Mount Tam in my backyard. What's this hill back here?
Then he
The U hill.
The U Hill.
yeah, which way are you putting?
Yeah.
Yeah.
So I got a question. So, you invested in $1 back in 2011. How much money would you have today?
250?
Hey, my phone.
You could try.
240.
Who's good at this math stuff?
Yeah.
Leonard? Leonard?
233.
So if you have 100% return, and you had $1 at the beginning, you have $2. What if you have 100% return from there? You're up to $4.
Yeah. Logarithmic.
Right? So it's compounding. So one thing that is that you double your money and then you double it again. $2 to $4, $4 to. And Richard, you were talking about retirement for you, and that's what you got to tell your kids and your nieces and nephews and who are saving today, is that power of compounding over multiple years is extraordinary, because it's not, you double it once and then you double what you doubled, and you double what, if you don't spend it and if you keep it, it's very powerful over the life of an investment time horizon.
What does this look like if it was 2008?
That'd be, we'll run that for you. So we'll run it starting in 2000 and let's say 7 or something. And the first, you'll see a 20% drawdown, and then from there you'll double and double and double, right? Yeah.
So losing $3 billion a month.
So this chart, basically, zero would start around 350 million for us here. So 350, 2011, yeah, middle of 2011, so pretty close here. 350 to almost 850.
Yeah.
So, okay, so if we had 350 million at 211, why don't we have the $4? Why hasn't it quadrupled? Why are we at 830 or whatever?
We're taking money out.
Well, this is cumulative, probably time-weighted returns would be my guess. Why that is.
Right. You have money coming in and money coming out too, so you're making benefit payments, and you're in a net negative. It's not extraordinary, but you have more money going out the door every year than you have coming in. Okay, so that's kind of the stuff I wanted to share with you. I think your expected return remains reasonable, and it's north of your actuarial assumed rate from our perspective. Your actuary always has slightly different numbers because they have slightly different inflation forecasts. They might have a different time horizon, 30 years and not our 10. So there are reasons why they have slightly different numbers, but we're coming in about 7, a little north of 7% for you. Okay,
We're doing good.
doing great. Any questions?
What's the actuarial number return?
Our actuarial return
6.5.
was, on a smooth asset basis for the June 30, 2025, valuation was 7.9. Is that right? 7.7?
Yeah, depends on what, obviously, number you want to look at. A 15-year valuation value return of 7.36% at June of last year. On a market value basis, which is not what Callan is calculating, but from the actuary on a market value basis, using simple averages, 8.64%, 15-year average net return.
But the 1 year, I think, was like 7.
Yeah, 7.61.
7.6, 7.9. I'm dyslexic.
761.
All right, thank you.
Okay. All right, well,
That's
thanks
a
for
good-
your indulgence.
That's a
Appreciate
good-
appreciate
good
appreciate the
report.
time. Okay,
Thank
Appreciate
you
it.
very much.
okay, great.
Yeah.
And
Is
that'll
Claire
bring up-
still out there? Yep.
Yeah.
Anyway, thanks, Greg.
Okay, good to see you.
Really cool to see you too.
Thank you
That-
all.
Brings us to the second item on investment matters. Item B, better be looking at the right thing here. December 2025 monthly investment performance report. Robert Ravelis, Retirement Financial Investment Officer.
Thank you, Chair Land. Trustees, you've got the monthly investment report. The one item I would note is the $8.6 million pending trade on page 2. That is our first funding round to Kane Anderson. And so we sent them that money on the 2nd. And so here we had to raise the money before the month end, so we've got it sitting waiting to go, which was a Friday. That's all I have to comment on that.
Are there any questions for Robert at this time? Comments? Okay. That will bring us to item C, County Employees Retirement Law Systems Investment Fee Review. Robert Ravelis, Retirement Financial Investment Officer.
Thank you, Chair Land. Trustees, you've got the California Retirement Systems Investment Expense Update. This is a follow-up to the discussion that we had at last month's meeting related to what are our expenses and how do they relate to other systems. In the memo, I laid out some considerations regarding this particular metric. But we really just wanted to show trustees where we land doing this very simple, basic calculation using current ACFR data. And so on page 3 of the document here, you can see we've listed each system. We've listed the particular metric, total expense ratio, in the middle column. That's how this is sorted. And we have the net position as the final column. The reason we've got the net position here is because larger investment accounts can demand lower fees. So that's part of the consideration that you need to be aware of when you judge this total expense ratio. The other thing I guess I would point out for trustees, which I do mention in the memo, is that this total expense calculation, there's a lot of nuance related to not only the reported fees, but why those fees are reported as they are. And so on the on the 4th and the 5th pages here, we go into a little more detail to try to give additional basis for understanding why some of these fees could be lower and why some of those fees could be higher. And that really comes down to what type of asset allocation do these other systems employ and what percent is passively implemented. Systems that have lower passive implementation are going to have generally lower fees. And so we've reported total and passive active for 4 systems, of course, ours, Sacramento, San Diego, and Imperial. Imperial is a comparator agency. Sacramento and San Diego are not comparator agencies. Sacramento and San Diego are on opposite ends of the spectrum. If you look at page 3, you can see San Diego has the lowest out of the 20 systems. And CalPERS and CalSTRS, I guess I would note that. Sacramento is on the more expensive side. And so if we look at their asset allocations and their passive versus active implementation, that sort of shows us exactly why the fees are low on one side and high on the other.
And as Robert did point out, this is based on the information as they present it in their ACFR, and there are some reporting differences between agencies. But this was a good snapshot that shows that where we rank within roughly 22 California retirement systems, and our fees were the 8th lowest, I believe, is where we fell.
Questions?
Well, just a comment. You generally answered my question about your last few comments because I was looking at San Bernardino versus San Diego versus Sacramento, and the total expense ratio being Sacramento and San Bernardino higher, and San Diego pretty low.
That's right. And the primary reason for that, if you look at the final page here, page 5, Sacramento and San Diego really stand out in the differences of their passive versus active implementation. They both have similarly complex asset allocations, but the main driver of those cost differences is what are they choosing to use passive implementation on. And so in our portfolio, we've got our 2 largest investments, single investments, passively implemented. And we can see that on page 4 here, where we've got a total passive ratio of 43%, which is, again, on the higher side. And part of the reason that we rank in the higher in the lower tiers of expense ratio is because we've got 2 of our largest investments passively implemented.
So San Diego is all basically,
They're almost like 60% passive,
Yeah.
and a little under that maybe.
58.
These don't necessarily show you the returns those funds received. It's just a fee comparison, but obviously some of those funds expect that some of those alternative assets and other things may provide them with the return they feel is necessary.
Well, and we do show total net returns at the very bottom here, also just so trustees can kind of review that for your own knowledge, right? Because there's always sort of 3 questions. How expensive are we running the portfolio? What was our return versus our benchmark? And how do we compare to other systems? Those are the 3 questions that sort of coming up all the time. So that's what we're hoping to answer with this brief report.
And as of this measurement date, which was June 30, 2025, MSERA outperformed its benchmark in the 1, 3, 5-year periods and was very close at the 10-year return period.
So if you were to look at everybody and list them in let's see, column addresses.
We should have put the percent passive in that first table.
Yeah, I mean, it would be interesting to know what the performance was at the end.
For everybody?
Yeah, in that first column, like how they performed for that period, to see if they at San Diego, it's low cost, but did they do half as well as the guys doing 1.38, or did they do twice?
Yeah. So I did just try to provide a brief snapshot here. Obviously, I didn't go through every single one and list them in a concise fashion, which I could do with board direction. I'm more than happy to do that.
Well, the debate we've heard in this room over the years was basically you could spend 0.2 and do as well as spending 1.8 or 1.4, and I think that.
Well, and if you look at San Diego on the last page, their 1-year return at June 30 was 11.2, and they came in slightly below their benchmark at 12, so almost 1% below their benchmark. When we measured at that date, we actually came in at 12.8, 12.1?
Three.
12.2, oh, 3. Slightly ahead of our benchmark at 11.9. And so there are differences in the portfolio structures between all the different plans. So you're not exactly comparing apples to apples, but San Diego certainly has a higher percentage in index type, and their return happened to be slightly lower than ours last year. But that's not necessarily to say it's going to be that way every year, because it's not.
I would also point out there's also differences in the benchmarks here.
Yes.
Right? So there's differences in all the benchmarks, there's differences in asset allocation, there's differences in total passive implementation, and there's also differences in what fees are technically reported in these ACVRs. Okay? So this is really trying to provide a simplified picture of a somewhat complex comparison.
I'm sorry, go ahead.
I would be curious if you could easily, without too much time, do the same for CalSTRS and CalPERS.
Well, they're in this list, but not the details.
But yeah, I mean the detail.
I would mention it was very relevant that what Robert said about what fees are actually reported in their ACVR. I do know from speaking with another system that they're only reporting direct fees that they essentially have to cut a check for, and they're not reporting any of their indirect fees at this point in time. So that makes their fee basis look artificially low, and as they change that to start reporting estimated fees that are indirect, you'll see that their fee cost increases.
Yeah, so that's another thing that's good to mention. You know, in particular, the one on this list that stands out when I was compiling these numbers, Marin County's number is most certainly understated. They are not including all of the fees that the system is incurring in their reports. So the one that Doris is referencing is Merced. We knew that. I could tell just by looking at the numbers that that was the case, and we did verify with them. I did not verify with Marin, but I would bet 99%
It's the same.
certainty it's the case. So.
And when you talk about the net, you're considering the fees in there.
All the fees. So our 57 basis points is all the incentive performance fees we pay. That's all of our custodial fees. That's Callan's fees. That is every imputed and direct fee that this system incurs.
Including our annual valuation, because that is a permissible item that you can charge to investment expense according to the serial. So some people don't really think about that, but the cost of our annual valuation of our actuary is also part of our total investment management fees that we report.
So if we excluded those fees that the other, that you suspect or know that the other plans are excluding, do you have any guess as to what our total ratio would be?
Oh, if we pulled out all of the indirect fees?
Our total ratio, our total is 57.
Right, no, if we were to pull out
The indirect.
the indirects.
I think we
and
showed
include
that
it-
last month, didn't we?
Yeah, I mean it's
Or the other way.
it's like 20. I think by memory, which I could be wrong, it's like in the 20s, low 30s. I
Okay,
believe.
so it's right there in line with where Marin is in LA.
Now,
For
LA
different
might be
reasons.
reporting all their fees, but they
They're
have
in a
such
very
a
different-
large
we can't really compare
asset
them.
base that they obviously can negotiate.
San Diego's suspiciously low there as well.
We
And-
believe that to be an accurate fee total, though.
Yeah,
Okay.
yeah. I think that's actually true. Some of these I think are really very close. San Diego, LA, Santa Barbara. I think CalPERS, Imperial. All of those look to be completely accurately when I backed into these numbers. A few of them are clearly not.
Which just shows the difficulty in comparing the cost of our portfolio to the cost of another portfolio, because we don't know necessarily how that system is presenting that data in their financial report.
So the question, I guess, would be if you did have all that, would we move up Or would we move down?
We would not move down.
We would move up.
Or stay essentially the same, because there would be a couple of systems that might show an increase in their total fees, but whether or not that would be large enough to move the needle that we would be higher in the ranking, I do not know.
Mm-hmm. Okay.
Okay, are there any further questions on item C? Questions, comments? All right, we will move on to item 5, Tax Council Services. Doris Rinchler, Executive Director.
Thank you, Chair Land. So our contract with existing tax council expired at June 30, 2025. We did not execute another contract at that point in time because we had no pressing tax issues to address, and we had just completed the correction project and had our IRS compliance statement. So we have come up with a couple of items that may require some assistance of tax counsel. I reached out to the other serial plan systems, inquiring about what firms they use and the fees that they're paying for their tax counsel, and asked about their satisfaction with tax counsel. There's 3 primary players in the county retirement plans that provide tax counsel services. Those are Hanson Bridget, Ice Miller, and Buchhalter. Based on the level of satisfaction and the competitiveness of the fees, we would like direction to go ahead and reach out to Buchhalter to negotiate a contract based on our needs and the satisfaction rating that they receive from their other clients in our survey.
So when you do something like this, like to me, engineers and attorneys are, going out and comparing them is really tough. Do you ever ask them to opine on something that we've already had an opinion on, or how something came out, on how they do it different, or how they do it better, or was it good?
Well, I can say that as part of the VCP, we worked closely with both our tax counsel and fiduciary counsel, so we sometimes did get some differing perspective on items that we were addressing within that correction project. I have not specifically said, here, we're looking at hiring you, how would you approach this, and then compare it to the answer that we have already obtained from existing tax counsel. So to answer your question, no, I haven't specifically asked that.
Yeah.
Where is Buchhalter based?
They're somewhere in California, I believe, but I would have to look it up. I don't recall. The attorney with Buchhalter who is servicing, I believe, all but one of the other serial clients that they have, is actually an attorney that I'm familiar with because she was with a different tax consulting firm when I was at Fresno, and she was the tax counsel there at that point in time. So I do have a little bit of experience having worked with her, and I was very happy with her services when I dealt with her at Fresno, but that was many years ago.
I'll just add that I reached out to my counterparts as well, and there was a lot of support for the Buchhalter firm. And the attorney that we're looking at did a presentation at Zachers, and I thought it was well done. And so I was impressed. I got to see her in person, and the feedback on her has been positive.
So you want a motion?
We would need direction from the board.
I'd like to move staff recommendation.
Discussion? I have no objection myself. Are there any objections to recommending?
We need a second.
No,
As direction, no, it just needs to be consensus of the board.
Yeah. It sounds like there's no objections to that, so you are so advised.
Okay, I will reach out and we would bring back potentially specifics. Jeff, does this have to have a contract come to the board before it gets executed, or does the fact that the board's given us this direction mean I could execute the contract?
It's in the budget. I mean,
We have allocation for attorney's
yeah,
fees.
I don't think it needs to come back to the board unless the board wants it to.
Okay, thank you.
Okay, that will take us to item 6, Board Policy Review. Doris Rentschler, Executive Director.
Thank you, Chair Land. We have 3 policies that were due for review. The PEPRA compensation limit policy, the retired member mailing service policy, and the SACRS voting proxy authorization policy. There were no substantive changes to the PEPRA compensation limit or the retired member mailing services policies. There was a minor change in the SACRS voting proxy authorization policy to strike a sentence that said if the board had not provided direction, but that there was a board policy on that matter, the delegate could vote in accordance with our policy, and we just simplified it to say the voting delegate would either vote based on the direction of the board, or if there was no board direction, not vote.
Okay, is there any discussion on any of these 3 policy items? I don't believe there was any changes to the PEPRA at all. I wasn't able to find any.
I think there were
Compensation.
a comma and a typo correction, maybe.
I couldn't find them. I looked, but that's okay.
Other than that, it was just really indexing them for the dates, saying that they were reviewed by the board.
And then the SACRS voting is simply don't make it up if you don't have direction. Okay, and I think that's probably a pretty good idea. Does anybody have any discussion they'd like to offer on this? Okay, so I guess at this point, we can entertain a motion.
Public comment?
Is that before or after?
I don't
you
know. I never get those order right.
I actually had to run that through ChatGPT, and I didn't even get a clear answer from.
That's what we have board counsel for. So do we ask for public comment after board discussion, after there's a motion?
So I think probably the better practice is to have a motion and a second and then ask for public comment. That's the better.
In either case, I don't believe there will be any public discussion. Okay, so I can make it up then. All
Some
right.
people feel like you should have the public comments and then make the motion.
In case the comment sways you.
But then you have to comment on the motion. Then you have to be able to comment on the motion.
So you have to do it before
Ah.
and after.
Yeah, if you do it before, you have to do it after, and at some point you do it. But you can't take action without comment on the motion.
I've never been too troubled with this board just because we don't usually have any public comment. But I do think that's correct, and that's why I think the better practice is having motion, because then the public can comment on what action is actually being proposed.
Not to be a wise ass, but I think on the contract, you need to have the board vote unless you specifically authorize Doris to sign a contract with a motion.
The tax council and all council is a service reserved for the board. So unless the board, I think, provides direction that I'm authorized to go ahead and execute that contract.
Right.
So I guess that would need to be part of that direction. Going
Yeah.
back an item, I apologize.
Yeah,
So were you looking for a motion for 6A, 6B, and 6C together?
Yes, desperately looking for that motion.
I'll move 6A, 6B, and 6C.
Okay, do we have a second?
I'll second if no one else does.
I will.
Oh, we have 2 seconds. And now we will ask if there's any public comment. And there is none. So, Judy, can we have a roll call vote, please?
Mr. Kelly?
Aye.
Ms. Cavness?
Aye.
Mr. Haschak?
Aye.
Shoemaker?
Aye.
Ms. Harris?
Aye.
Cubison? Aye. And Chair Land?
Aye.
Thank you.
Okay, 7, quarterly board work plan, staff work plan, and strategic calendar. Doris Rentschler, Executive Director.
Thank you, Chairland. The strategic calendar for 2026 is in the board materials. It shows where we have items planned throughout the year. I would like to note that the red X's are items that appear periodically, like only every third year or so, and those are items that will be handled in 2026. After the calendar, which or actually page 3 of the calendar, we do have different educational topics listed that are going to be presented in-house. It also has a list of conferences that the trustees may be interested in attending to receive their educational credits. The board work plan is the slightly simplified format. This is still a little bit of a work in progress, but we do have some of the new items based on our strategic plan discussion from a few months ago. And as noted at that point in time, I've split it into a board work plan and a staff work plan. So while there are items that overlap between the two, the board is more of the high-level overview and decision-making on items, and then the staff work plan is implementing some of those directions. So if you have any questions regarding the calendar or the work plans, I'm happy to answer any questions you have.
Questions? No questions. Okay. That will bring us to item number 8. Administrative report. Doris Rentschler, Executive Director.
Thank you, Chair Land. Just a couple of reminders. The Form 700 filing, starting with reports filed in 2026, which means your annual report for year 2025. Trustees are required to file the Form 700 disclosure directly with the Fair Political Practices Commission using the Commission's electronic filing website. More information should be forthcoming from the FPPC regarding the filing portal, and as that information is available, we will make sure it gets out to you. The 2025 Form 700 is due by March 31st, 2026. Also, for trustees who are leaving the board, you are required to file a Form 700 as you leave the board. You may be able to file those with Judy at this point. I don't know. Maybe not. Since the portal's not up and running. I would say, Richard, you could probably file yours with Judy since the portal hasn't been expanded for all of the local boards that will need to file directly with the FPPC. I would also point out that the FPPC does offer free webinars on how to file the Form 700 as far as what information needs to be included on that and what the disclosure requirements are. I did put a link in the board memo to their Form 700 filers training and outreach webinar in case you're interested in checking out those requirements. For trustees who have not already paid, the waiver of recourse premium is due. Please remit payment of $10 to Judy. Payment by check is preferred, but we will take cash if necessary. That waiver of recourse covers you in the event that we had a claim against our insurance and they paid, that would prevent our insurance company from coming back against any individual trustee to try to recoup losses if there was a settlement and claim paid there. Just an update on the RFPs. We did issue the RFP for consulting actuary on January 12th, and finalist interviews will be scheduled to coincide with the March Board of Retirement meeting. So I do need development of somebody or assignment of somebody for an ad hoc committee to review proposals so we can get that shortlist. Chair Land, if you can assist with that today.
Okay, how many of the trustees?
I would say a minimum of 1, 2 might be better, but
Okay, I don't know if it's possible to understate how exciting it is to review RFPs. So is there anybody who is interested in reviewing these RFPs when they come in?
And what is the nature of the RFPs?
there's actually going to be 2. This first one coming up is for consulting actuary services, basically the work that Siegel provides to us. And we will be issuing another RFP in March for investment consultant. And so whoever gets assigned to this committee, I'd like them to just handle both,
Oh,
if that's okay.
I was already going to volunteer for it, and I probably will continue to volunteer, but I just, once again, it's very exciting, and I don't want to exclude anybody who wants to read through these RFP responses. Do you want to read through them?
Yeah.
Okay, so why don't we put both myself and Trustee Swope on that?
Oh, great, thank you.
Okay.
An update on the election situation. We have announced the retirement special election for the retired member seat 8. That special election will be held on April 10th, 2026 for the remainder of the existing term through November 30, 2026. Declarations of candidacy are due by February 13th, 2026. We have, I believe, one candidate declared.
What's the nature of how you conduct the election for the retired member?
So if we only have one declared candidate, we would simply go to the Board of Supervisors and ask them to cast their one unanimous vote and not actually mail ballots out. If we have more than one candidate, we will mail ballots to all of the retired members, and then those ballots would be counted at the April 10th date.
Okay, so April 10th is when they would be counted. We would need to have mailed them out before then.
Yes, and this gives us time between the declaring deadline of February 13th to determine the number of candidates, if we need to print the ballots to get that stuff printed and mailed, and then get the responses back by the Friday before that Monday. I believe April 10th is a Monday, so we would then count them all on Monday. On the safety member seat, we have reopened the declaration of candidacy period, and it will remain open until someone declares. And I just wanted to let the board know that Siegel, MSERA's actuary, did present an overview of our valuation at the Board of Supervisors workshop on January 13th, I believe was the date. And our valuation will actually go back at the February 3rd meeting for adoption of the rates for the coming fiscal year. There is a notice of election for SACR's Board of Directions. Anybody interested in serving, your nomination is due to the SACR's nominating committee by March 1st. You can review the material in your packet. If you have any questions, please reach out to me. And if you have any questions regarding anything else on this item, I'm happy to answer any questions you have now.
Do we have any questions on any of the items? Seeing none, that'll bring us to item number 9, general board discussion. Does anybody have any discussion items? Anything in general? I will just say that I seem to be incapable of remembering to bring my checkbook, and so I'm going to have to pay by cash today, even though it says that a check is preferred. I write almost no checks, and even finding my checkbook might be a chore.
Richard,
What's the insurance period? Do I need to pay?
You do not need to pay since you're exiting the board. It technically runs, I think, from
The
November
policy
30.
date, the November to November policy beginning and end date, yes.
Okay, so I'm liable for November till today.
No,
But
So it's up
we
to
do
you if you
anything
want to,
radical.
if you want to pay it.
I do not, we always introduce the people from the audience.
All right, is there any other items for discussion? Robert?
Just one follow-up. You asked while we were looking at the expense report, where would we rank if we only had our direct expenses, and that would be 24 basis points.
Okay.
So that would jump us up
All the way.
to number 2.
Right.
Yeah.
That's good to know. So I guess that moves us on to item number 10, adjournment, and notice of the next Board of Retirement meeting. And this will be different than the other adjournments that we've done. The next public meeting of the Board of Retirement will be held at the Wanacott, hope I'm saying that correctly, Conference Room, 400 East Commercial Street in Willits, California, on Wednesday, February 18th at 9:00 a.m. This off-site meeting will not be live streamed or recorded, and remote attendance will not be available. And there is a link here. You may visit mendocinocounty.gov/retirement for meeting information. Thank you very much, and we are adjourned.
Did you have something to say,
Oh.
Catherine?
Well,
We're not adjourned.
I wanted to know a little bit about the gentleman in our audience.
This is Vince Lekowick.
Okay.
He is a retired member, and he has expressed interest in serving on the board. He has submitted a declaration of candidacy.
And I read almost everything that was on your website, the attachments. I'm going, wait a minute. This is not going to be easy. You have to think.
Yep.
Think. So I was surprised at the amount of work that's actually behind your meeting. So hopefully it doesn't, and to fill Mr. Shoemaker, Richard's shoes, kind of intimidating, so I'm not sure. That'll work out.
I'll cut it out.
It can be a little bit intimidating at first, but I'm sure you'll find your voice quickly. If you know, of course, you're elected. Okay. Now we are adjourned.
Thank you.
Your paperwork.